Good afternoon. Thank you for joining us today, and welcome to session number 8 of the Marsh Captive Solutions 2020 series. For those of you that don't know, 2020 represents the year 2020. It is the Friday closest to the 20th, and it's only going to be 20 minutes. My name is Arthur Kortzinski. I lead the North American Captive Advisory practice for Marsh. Joining me today is Dan Davey, the Mercer stop-loss practice leader. His team of 75 colleagues oversees over 1,000 placements, representing in excess of $1 billion of annual premium. Let's take a look at how captives can be used to support medical stop-loss financing. And of course, we can't have a session without talking about COVID-19. We're still trying to measure the impact that's going to have on stop loss, but my guess is when factored into a lot of the medical costs, it's going to make stop loss even more of a hot topic next year. So a couple of ways that clients use captives for stop loss financing. The first is like property casualty risks. A captive can buy down retentions for business units within a self-insured entity. Like workers' compensation or liability, you might have $500,000 or $1 million retention. A captive can be used to buy down part of that retention. However, generally, stop loss can't provide first dollar cover, or there could be some regulatory issues. And lastly, since it's theoretically unlimited, a layer of risk above what a client may retain may come back to the client, because regulators don't like to see unlimited coverages in their captive. Another option for single owner captives is to access reinsurance. And by accessing reinsurance, we may be able to restructure retentions, lower the costs of risk transfer, but more importantly, lower some of the transaction costs associated. Another big captive use is group captives, and they can create capacity and help clients develop negotiating leverage with insurance markets. There are somewhere between 75 to 100 heterogeneous group captives designed for middle market organizations. Typical retentions could be as low as $250,000 with a next $250,000 layer going into the captive. And then a traditional stop loss provider would underwrite, issue policies, handle claims, provide reinsurance, both on a specific and aggregate basis. And lastly, larger organizations can set up pooling mechanisms, and because retentions are significant, perhaps access reinsurance at very high attachment points. Dan, can you give us some insight into the current status of the stop loss market?
Yeah, sure. And just to level set, and one of the reasons that this is coming up more and more frequently is just the severity and frequency of large claims and self-funded plans has increased significantly over the past few years. So this chart here just gives you an indication. It's from a Sun Life financial survey. They're one of the largest stop loss writers in the U.S. Just give you a sense of, at least the frequency of some of these claims. So for example, between 2016 and 2019, the number of claims over 3 million has doubled. So certainly for larger organizations, this has a material impact on their risk strategies as it relates to the self-funded medical plan. Next slide. So one of the drivers of the increase in these large claims is specialty pharmacy. So I'm not going to go bullet by bullet here, but the highlight is that there have been a number of very high cost therapies that have hit the market recently, gene therapies in particular. A couple of those examples are things like Zolgensma and Luxturna. Zolgensma, for example, which comes with a price tag over $2 million. So certainly, historically drugs has, kind of been the smaller piece of the self-funded plan, but with some of these new gene therapies with 7-figure price tags, that story is changing a bit. The pipeline's pretty robust. So there's quite a few more of these types of drugs in development. There was a hemophilia drug that was supposed to be or had anticipated to be approved by the FDA earlier this year with a $3 million price tag, that's for one person, one treatment. That got delayed at least a year, but it's not going away, and neither is the trend. Next slide. So the pharmacy trends impact stop loss and catastrophic claims, not just in the size, but also in frequency. So historically speaking, these large claims that have hit self-funded plans have been or were acute incidents, right? You have an ICU or a NICU stay, an accident, things like that. But with developments in high-cost drugs, these claims can be expensive and stay expensive. So, obviously with a hospital stay, it happens. Generally the person's discharged, and then, move forward to claim levels that are, quote, closer to normal. But with some of these really large claims, you can end up with a claimant on $1 million drug that is $1 million every year to treat that condition. So obviously that changes the risk discussion quite a bit, and the risk retention for the self-funded plan. Next slide. So most clients, or a lot of certainly small and mid-sized clients, protect themselves in their self-funded plan with the use of stop loss. So you can see in this chart, this is from the 2019 Mercer survey. The left half is, the prevalence of stop loss among self-funded employers based on a number of employees. And as you would expect, the smaller the group, the more likely they are to buy stop loss. But as you move left to right, that percentage drops off a bit. And historically, those are decisions that were made, frankly, before some of these trends in specialty RX, and certainly before the frequency and severity of these seven-figure claims have been increasing the way they have. The right half of the page just gives you a kind of an idea. The number one feature of stop loss is the deductible level. So as you can see, again, as you would expect, as you move left to right, and the size of the group gets larger, as does the deductible. So you can see it's as low as 100,000, and these are medians for smaller groups, and then you move all the way from left to right, and getting up close to $1 million.
Dan, you mentioned in a prior slide that there was going to be a new $3 million drug. And is that a one-time drug someone will take, or will they have to take that every year?
Yeah, it's a little TBD. Obviously, it didn't get approved by the FDA. And I think the early indication was that, it's for hemophilia A. Early indication was it would be, quote unquote, a cure. But the timeline associated with that was somewhere at least 5 years. So, at least short term, it was would be a one-time hit to a self-funded plan, but they did not rule out the need for future treatment.
Tracy, if you could go back to the prior slide. I find this really interesting because I think it maps out with some of the group captive options that we talked about and other captive options, where on the left-hand slide where we have the number of employers. And Dan, please confirm that there's somewhere, between 205 to 10,000 would be the right size for these middle market captives. But once they get larger than that, the retentions are too high. And conversely, because of that kind of 250 self-insured layer that a small employer might keep, or mid-sized employer, and the 250 layer then that's being risk pooled, is it true that once you get into these higher levels on the right-hand side of the page that these group captives might not fit exactly?
Yeah, that's true, because the retention in the captive layer becomes relatively small, at least from a premium standpoint. So a lot of times they don't necessarily fit the model.
And with the advent of $3 million drugs that we don't know if they're going to be once a year or forever, I'm surprised that we don't see more large employers buying stop loss.
Yeah. So if you want to move to the next slide. So, the stop loss market, is targeted at mid-market clients or smaller clients. So, for example, the availability of deductibles of, $1 million or higher is fairly limited, right? You run into some minimum premium issues, meaning that, for example, a stop loss carrier won't want to write a $2 million deductible for a 500 life group, right? It doesn't generate enough premium. It's not a layer of risk that it is as at all predictable. So it's just something that they don't the market just doesn't support. The other thing is some of these carriers, or most of the stop loss carriers, purchase reinsurance on their own blocks of business. So, at some point it becomes a transfer, or pass through of their reinsurance costs. And again, it just doesn't, isn't something that they're interested in doing. Stop loss market has, hardened over the past few years. Certainly, when we look at charts like we did early on the prevalence and or frequency and severity of these large claims, I mean, they're seeing them. The carriers are seeing their loss ratios, increase. And as a result, prices have increased along with it. Carriers have become more selective on the risk that they want, the groups they'll write. And, nearly half of quotes or RFPs are met with a decline from the stop loss market. So it's just becoming a little more difficult for some clients to find coverage in the stop loss market.
Thanks, Dan. And Dan and i.e. Marsh and Mercer have been working together trying to come up with options for larger employers. And as you recall from that slide, once you get to 10 to 20,000 employees, generally employers just aren't buying stop loss. And any claim above, the highest claims that we saw 10 years ago, Dan, would have been in the million range or 2 million range, but it wasn't pharmacy driven, and it was a one-time event, correct?
Yep, correct.
So there's a lot more interest from larger organizations because, a $10, $20 million claim can impact the P&L, specifically if it's allocated back to a division. So one of the solutions that we've been working on is accessing that reinsurance market that is comfortable attaching at a much higher level. And this is the iteration of a plan where there would be a $3 million per claim or per person per year deductible per employee with reinsurance attaching above it. And this reinsurance would be purchased on a group basis, thereby allowing leverage and having an accumulation of premium so that the reinsurer will have a spread of risk. Most of these stop loss renewals are around the first of the year, and we are working to develop this and put some quotes together to have this captive operational by year end. What makes this different from just buying stop loss would be making it a 2-year facility, which would allow the ability or allow a provision for no lasers. And Dan, can you explain to the group, what this concept of lasering means? But more importantly, what's some of the kind of oversight that Mercer might be able to offer to help manage a $2 or $3 million claim?
Yeah. So on the oversight side, it's important that these claims are identified early, right? So generally speaking, there's some reporting that is provided by your medical or pharmacy carriers to stop loss or reinsurance carrier. So it's important to keep an eye on that. It's not always necessarily the dollar amount early on that is problematic, but rather the diagnosis or the condition, because there's at $3 million, there's a lot fewer conditions and treatments that can get there, right? Than if you're talking about a $500,000 deductible. Just, it's not possible. So the scope of the conditions you're worried about, the drugs you're worried about, treatments, it's a shorter list, but a lot of times the ability to impact that treatment or the cost of care or the location of care happens very early on. So it's important to keep those identified. Regarding the topic of lasers, so lasers in the stop loss market means, when you request a quote from a carrier and they look at the claims experience as they would to underwrite the risk, if they identify someone that has a condition or ongoing treatment that they expect or reasonably expect to get to or exceed the deductible you're requesting a quote for, they'll quote laser that person, meaning that maybe they exclude them from coverage altogether. Maybe they set a higher deductible for that member. It's essentially cherry picking the risk, and on new business, they have the ability to do that. Within the captive product, so one is there's just fewer things that will hit $3 million. So meaning that the need for these lasers is minimized quite a bit just by but just by the deductible level. But then also it comes with at renewal, a no new laser guarantee. So at the second year, when it comes up for renewal, they're not able to cherry pick the risk at that point. They've locked into a maximum rate increase, and they don't have the ability to kind of pull members out of the coverage at that point.
Thanks, Dan. And I'm going to ask one question now that I understand how these lasers work. I keep going back to the slide where you indicated the size of the employer groups. I'm not sure I understand what a self-insured employer with 500 or 1,000 employees would do if they ended up with one of these recurring $2 or $3 million claims.
That's a good question. And sometimes there's once it's occurred, then it becomes essentially an uninsurable risk, right? So if you're one of these groups that does not buy any coverage today, whether it be stop loss or reinsurance, once you have that member on your plan, once that treatment is begun, you can't get coverage. So a lot of times we will get requests from groups that historically haven't purchased stop loss or any kind of coverage for these catastrophic claims. Something hits the plan, they find out it's ongoing in nature, and then look to insure that risk. Well, at that point, it's known risk. And as you might imagine, carriers aren't that excited about taking on known risks. So then it becomes very difficult, if not impossible, to get coverage for that person with that condition. So, a lot of times on the front end, when your plan has been lucky enough to avoid some of these big 7-figure claims, that, even though it may seem counterintuitive, that is the time to buy the coverage. You lock in, so that way for multiple plan years, if one of them does arise, that you have the appropriate coverage. And make no mistake, even with or without coverage, you don't want a $3 million claim or anything above that, right? Because obviously the organization is funding, the first $3 million of that claim.
Dan, thanks for the insight. And from a closing perspective, for those of you on the East Coast, it's lunchtime, and this was just an appetizer portion of medical stop loss and how it might impact captives. If there are any more questions, please reach out to Dan or me. And we look forward to you seeing us on session number 9, which will be November 20th. Thank you.